Hey guys, welcome back to another video, and today I'm here to talk about a stock that I think, because of the way that, economics are in America right now, the way that the government is moving, the way that the government is funding things, the decisions they're making, I think of this stock is at a very attractive price. It's going to do very well over the next 3 to 5 years, and this is the sector that you need to focus your portfolio on right now, at this present time, before September ends, before we get later into the year. I think this is what needs to be your main focus. So without further ado, if you do enjoy this video, be sure to smash the like button. It helps me out a lot. Also subscribe to the channel. I'd very much appreciate it. We are nearing 600 subscribers. Thank you guys again. Let's get right into it. So the ticker symbol for the stock that we're talking about today is ticker symbol O. This is Realty Income. I've talked about this stock before, but not really in this sense. I want to make more of an in-depth video on why I do believe in this company, why I think this stock is great. We see that this stock benefited heavily from the rate cut, and that is what I'm here to talk about in this video today. We see that it's actually had a decent year-to-date performance. They've had, a bad past year, and in the past 5 years they're down, while the S&P is up over 100% in the past 5 years. I'm pretty sure. I mean, if it's not, it's very close to there. So your money would have been better off in the S&P in the past 5 years, that's for sure. Yeah, it's at 103%. But if you go to O, I think that now is the right time to invest into O, as you get ready for this rate cut cycle. That is why you should invest in O. I think that it's very cheap right now. It shouldn't be this cheap, but they do pay a dividend yield of 5.39%, which is pretty hefty. Not a lot of stocks consistently pay dividend yields of that level and continue to raise them quarter over quarter, as O has done. We'll get into their earnings presentation in a second here, but yeah, I mean, O looks really solid. They always meet expectations on earnings. If not, they're beating a little bit. This one they slightly missed, but I mean, O is a very predictable stock because all of their income is so predictable. They have leases with these, big companies like Walmart, 7-Eleven, Dollar Tree, Dollar General, like companies like that. They have leases that are 20 to 30 years long, so they know, once they sign that contract, what money they're going to be getting for the next 20 or 30 years. There's not really any surprises in this company. It's not as interesting as, owning maybe Nvidia or maybe, buying some SoFi. It's not as interesting, but you know what you're going to get with this company, to say the least. So the Fed rate cutting cycle begins. This is a big thing for them because O's main, their main business model is to buy property. That's what they do. They buy retail spaces and then they rent them out to big corporations that are willing to pay these 20, 30 long year leases. And to buy these big retail spaces, they take out loans with the bank, which if the rates are lower, they're making more money on the top line, and then it's a never-ending spiral down of how, the O is making more money if the rates fall, and they're buying more things when the rates are low so that they can, prepare for when the rates go back up again, which nobody knows when they're going to drop. Nobody knows when they're going to rise, but it seems like the Fed is in a rate cut cycle right now. We see in a closely watched decision, the U.S. Federal Reserve opted for a larger 50 basis point reduction in interest rates today rather than a more traditional 25 basis point rate reduction. Today's rate cut marks a clear shift in the Fed's focus from taming inflation to protecting the U.S. labor market and the economic expansion. This is very true. The U.S. just wants to, I think they're not really taking the time to, this is just a personal opinion, but I don't think they're really taking the time to, quote unquote, fix the economy. They're not trying to do that. They just want to give out the best image and, keep moving forward no matter what that means. Maybe that's a recession in the near future. I'm not sure what it's going to bring, but I don't know. They could be moving a little too fast, in my opinion. But we expect the Fed to cut rates by 25 basis points at each of its remaining meetings in 2024, and to sustain that pace into 2025. This trajectory would get the Fed down to our estimate of the normal or equilibrium rate of interest of 3 to 3.25% this time next year. So if that's the case, if we have a 3 to 3.25% interest at this time next year, things are looking really good, in economics in America. The economy is looking great if we have a 3% interest rate, comparing to where it is right now and where it has been for the past couple years. If we can get it in the low threes like that, that would be great, especially if we start nearing those 2%. That's where, everyone benefits a lot. So there's not really much more I wanted to look at in this article. I just wanted to look at that headline right there because O is a stock that, heavily benefits off of the interest rates. That is, their whole business model is, buying companies through loans, which loans are, paid off with the interest rate imposed on them, which is decided through the federal funds rate. which we saw in that. So this is O's investor presentation. This is from Q2, their quarterly results presentation. Let's open that up. We can see that they own a lot of big places. So these big companies are renting out O's space. They have lease agreements. We see that 73% of their annualized base rent is non-discretionary, low price point and or service oriented retail. Having retail owners as your main leasers, as your main renters, is the best thing you can do, because these are big businesses. They're cemented. They're gonna pay you. That's just part of their expenses. That's part of their top line, is giving you money to stay in that location. And also you have these long contracts with them of 20 to 30 years that you're not worried about going out anytime soon, because they're here to stay. They have $81 billion enterprise value, 56 years of operating history, around 34% of rent from investment grade clients. We love to see that. It's high profile customers. There's 661 monthly dividends declared, 111 consecutive quarterly increases, which is pretty insane. And they are a dividend aristocrat in the S&P 500. That's pretty hard to do, and especially to have a 5% dividend, over 5% dividend, and be a dividend aristocrat is, there's very cut and few stocks that have that. They have a proven track record of returns, 13.5% compound annual total return since 1994 New York Stock Exchange listing. They're beating the S&P 500 since 1994. They're outperforming the S&P 500, which is very hard to do. There's, not a single stock out there that I can name off the top of my head that every single year has consistently outbeat the S&P 500, and that's just a hard thing to do. So that's something you definitely strive for when investing. I mean, this company is pretty predictable too. Like, yeah, there's companies that have outpaced it, but year over year, not really. I mean, there's some years where, these bigger companies that have outpaced it long term, obviously, they're dropping 40% while the S&P is up 3%. So those are the years where it's hard to hold and say, okay, I need to hold this company. I still believe in it. Those are the years where you probably sell, invest in the S&P, and then that company you just sold rises 60% and then outpaces the S&P 500. So that's just how investing works, if you didn't know already. But we see their 2025 guidance, reference their prior guidance. So now their guidance has actually dropped a little bit in some aspects, but it's also risen in other aspects. So it's kind of just what happens with companies as they actually see what is going to, happen with financials as the year goes on. The historical average dividend yield is around 6%, very high for any company, to say the least. I mean, this company just has so much cash that it's insane from their renting that they can't afford to pay out a dividend that high. I mean, this is a big part of their company as well, as people owning shares. So we see that their current diversification, their top 20 clients include 7-Eleven, Dollar General, and Walgreens as their top three. Three very popular companies that are very well known. They're very established, and they're very, financially backed. They're here to stay. Then we keep going down, and we still see that. We see Dollar Tree / Family Dollar, Lifetime Fitness, EG Group, Wynn Resorts, Kingfisher, FedEx. I mean, there's a lot of known companies on this list, and you can go to the side there too. We see Home Depot, Walmart, AMC, CVS, Tesco, BJ. I mean, there's a lot of very well-known companies on this list, and it doesn't really matter the profile of who's who's leasing these spaces from them, but it does matter in the sense that these companies aren't going to go out of business and put any of these leases in jeopardy. I mean, maybe they will, but it's just the odds of them going out of business and opposed to, a small business, it's pretty skewed in their favor. So we see the historical stable cash flow supported by high quality real estate portfolio. They do have a very high quality portfolio. If we look at the stock price all time, we can see that this company has actually done very well, up 466% all time, and they've been on the NASDAQ, I think they said, since 1994. So they're definitely doing good in that regard. We see their proven track record of value add, asset, and portfolio management. Looks like it's really exploding in 2034 that's 2143. So this company is thinking that they're going to be around till 2143. I can't even fathom that year right now, but I think that it's definitely possible. This company can definitely still be around. I'm not saying that that's not possible. Investments. So this company is still making investments. They're still looking to grow. This is a company that has, essentially made it, I'd say. And this is a big thing that I really wanted to talk about too. Talking about AI and all of this stuff. data centers. So data centers are where these big AI projects are going to be hosting all of their, humongous GPUs and everything that they need. These companies like Realty Income, these real estate companies that build big buildings, I mean, they're the ones that are renting out to these big companies. They're starting to build data centers. These data centers are for the AI companies that are, looking for somewhere to host their equipment. And these data centers are really just big concrete buildings with a bunch of shelves. Very cheap to make, very expandable, very, easy to expand on, and then easy to rent out. People are looking for them like crazy right now. So the fact, they have 200 million joint venture with Digital Reality, I like that they already have a partner in that. This is something they also started in 2023, so they've been on it for around 2 years now, which I also really like to see. They got in pretty early, as far as talking about AI goes, that's pretty early to get into these data centers. We see Realty's Income external growth opportunities are broad and diverse. I totally believe this. We see that, they're getting more selective. Their investment volume is increasing a lot. We see their sourced income. So, I mean, a lot of good things are what I'm seeing from Realty Income, especially preparing themselves for the long term with that, the data center. I really like that with them. So I like that a lot. We see Europe remains a compelling growth market for Realty Income, so they're also expanding internationally. Love to see that as well. Can never argue with that. Being international is better than being just in the US. You're reaching more customers, and especially for something like Realty Income, where they're literally just leasing out buildings. You can do that anywhere. So as long as they get the right deal, they can do that wherever they want, which I really like to see, especially that they're even looking, overseas. So I mean, kind of the more that we go down here, the more we see that it is, pretty much not as important. There is balance sheets. We can look at that real quick. We see that, everything looks pretty good for this company. It's not growing very fast, but I mean, that's not what the name to their game is. I mean, this company is one that's going to give you a return that you can expect, pretty much. And I think now is a great time to invest in it, because you can put this in your 401k, you can put it in your kids, what is it, 529 or 521 plan, something like that, for college. I think that this isn't a stock you want to, make 100% of your portfolio. This is not that. This is a stock you want to add maybe 5, 10, 15, 20 as the extreme most percent to your portfolio, I think. And you just want to have this as diversity, because as the stock market crashes, that's not true for the real estate market. They both move. They move somewhat similarly, but I mean, not at the end of the day, they're very different entities, and they're not going to follow the same patterns. I actually also wanted to check out this dividend calculator right here. This is a dividend calculator, essentially, where you can check how much money you'd actually make. So let's just see, if you were to invest into let's say you started with $100. Your initial annual dividend yield is, what is it exactly? It's 5.39%. So your initial annual dividend yield is 5.39%. Your additional contribution, let's say you invest $100 every single month, which isn't that crazy. It's not that hard to do. You reinvest your dividends. Your dividend tax rate is 15%, pretty standard. Expected annual share price appreciation, we see that. Let's go back to the investor presentation, and let's see actually what they said that was, because I think they put it on here. Okay, yeah. So it's 5.5% is their average share price appreciation. So we'll do that. And the average annual dividend amount increase, we see that that's about 4.2%. So we'll put that in as well. And let's say over 20 years. Let's say you're 45 right now, you want to retire when you're 65, and you just started investing. Let's see how you do. So you have $6,000 at the end. Not anything crazy, but this is, from not that much money. All you did was put in $100 at the beginning of every month, and you left, you had $0 at the beginning. You had $100 basically. So you can't complain with something like that. Let's say you're younger, maybe 25, you want to retire when you're 65. That's where the snowball method comes into play. You have 37,000 at the end. I mean, this is not, as great of a way to make money as investing in ETFs and such. But we see that also dividend income at this point would be over $1 million. We see that yield on cost would be around 29%. So you really can't complain. I think that the dollar amount actually might be a little bit off, but you see the annual dividend is amazing. once you get to this point. So this is, I mean, dividends really are like a whole different thing than growth stocks. Growth stocks are my favorite. That's what I'm investing in mostly in my portfolio, but I think that it is good to have diversity, especially in these uncertain times in the market. We don't know where we're going. There was just a rate cut that was probably a little bit too big, so that's kind of scary. That might be scary for a little bit. Market reacted positively, so can't complain, but it is, a big unknown at the end of the day. It always is. So if you guys did enjoy this video, that is all I have for today. I just wanted to talk about Realty Income and why I believe in the company, why I think now is a great time to buy. Because I think that especially if it's for a younger person, this is a time where the interest rates are going to be as high as they're going to be for a while. So if you do have, a kid or a younger person and you do have a portfolio for them, I think adding a little bit into this is probably the best thing. It's, there's no harm in it. And I think that it would be, something that would pay out really well. I mean, for every $100 you have in here, you're making $5.39 a year. And that's without the share price appreciating. So you could have, 10 shares of this company and you'd be making around something like over $30 a year, which is pretty good, as far as dividends go in the stock market. So reinvest that too, and then I see a pretty good future for you in the stock market. So if you guys did enjoy this video, be sure to smash that like button. It really helps me out a lot. I'd really appreciate it. Also, if you could subscribe to the channel. We are nearing 600 subscribers, on the way there. Thank you guys for watching. I'll catch you in the next one. Peace.